Oil prices are spiking, shipping lanes through the Strait of Hormuz are partially going dark, and equity markets are being forced to rethink inflation and earnings risk in real time. You are watching vTalkInsight, Equity Pulse Daily for July 14, 2026. Let us look at how geopolitics, central banks, and AI-driven earnings are colliding to reshape the risk-reward picture across sectors and key names. Oil has snapped back to the center of the macro story as the Strait of Hormuz shifts from a theoretical choke point to a live constraint on global supply. That matters for equities because it reopens the inflation debate at a time when valuations are already elevated. U.S., Iran military exchanges, strikes on Gulf infrastructure, and attacks on commercial vessels have sharply reduced visible shipping through Hormuz. Satellite data now show normal traffic replaced by untracked dark crossings, while operators weigh U.S.-backed southern routes against Iranian-controlled northern lanes. Brent has seen intraday spikes of around 10%. WTI has jumped close to 9% in a day, and European gas prices are pushing higher after fresh hits to regional energy assets. These shocks land on a system that was already tight. Gulf energy flows remain below pre-war levels, repair costs are estimated near $60 billion, and alternative Saudi and UAE pipelines are at least 12 to 18 months away. Russian refinery outages and reduced Chinese product exports have cut global refining capacity by roughly 10%, driving refining margins to record highs even when crude briefly softened. The macro consequence is a renewed inflation impulse, just as the Federal Reserve is trying to lean more on data and less on explicit guidance. Services inflation is still running above 3%, unemployment is near 4.2%, and markets currently price in one additional hike before cuts. Some now see fair value for the 10-year Treasury closer to between 4.75 and 5% once neutral policy, sticky inflation, and expansive fiscal settings are combined. Bond yields are grinding higher across the curve. Traditional 60-40 portfolios are under pressure, and gold is struggling as higher real yields offset geopolitical demand. Equities are feeling it. The S&P 500 has slipped roughly 0.75%, the Nasdaq nearer 2%, and volatility indices are into the high teens, signaling a market that remains orderly but far more sensitive to the next CPI print or headline from Hormuz. Earnings and liquidity are still the main counterweight to this macro shock. Profit growth for the current reporting season is projected at about 22% year-on-year, and second quarter numbers are expected to show around 20% growth, with U.S. technology heavyweights providing almost half of that uplift. Analysts are revising estimates up rather than down, and earnings momentum is projected to stay positive over the next year across most U.S. sectors, especially tech, energy, and banks. On that foundation, one framework sees a 12-month S&P 500 return of a little over 10%, arguing that a trailing price-earnings multiple around 24 times is defensible if inflation trends near 3%, policy delivers no more than one extra Fed hike, and 10-year yields settle near 4.5%. The tension is that several macro signals now point toward higher-for-longer yields, and some investors already view industrials as too expensive on a long-term basis, vulnerable to derating despite still solid fundamentals. Capital markets remain open. Large-scale debt issuance is running at record levels, with tight credit spreads signaling strong demand even if forward return potential in credit looks limited. U.S. IPO activity has already surpassed the 2021 boom, led by mega deals and AI-linked listings, while about $2.1 billion of global IPOs, mainly in weaker European sectors, have been withdrawn or postponed, underlining how selective risk appetite has become. Corporate M&A is also accelerating. U.S. deal volumes are expected to rise around 11% this year, driven by strategic buyers rather than leveraged private equity as higher rates make debt-funded transactions less attractive. Large-cap companies command valuation multiples roughly 40% above small and mid-caps, reinforcing the incentive for consolidation, while UK-listed firms continue to be taken private as overseas buyers exploit perceived discounts. That environment supports banks with strong capital markets franchises, but also raises the bar for earnings delivery. Large U.S. banks have seen estimates rise about 15% over the past year, and share prices climb roughly 30%, so any shortfall on trading, IPO, or M&A revenues could generate outsized moves as investors reassess how much of the good news is already in the price. Artificial intelligence is still the main growth engine in global equities, but it is also where volatility is most intense. Taiwan's semiconductor manufacturing company just reported a 36% rise in quarterly sales, with June revenue up close to 70% and management pointing to AI chips as the dominant driver. Growth is expected to accelerate again next quarter, reinforcing the view that the AI hardware cycle is far from peaking, and YesML is widely expected to confirm that capital spending by major customers remains robust. Korea highlights the other side of that story. SK Hynix dropped about 15 to 16% in a day, dragging the Kospi down roughly 9% and triggering another circuit breaker after a huge run-up over the past year. Its new U.S. depository shares now trade at a sizable premium to the Korean line, creating an arbitrage that boosts cross-border flows and channels volatility into U.S. chip names, while worries about a memory cycle peak and heavier capital spending needs ripple across AI-linked equities. Even so, the memory industry itself has become more disciplined. Capacity is consolidating into an oligopoly, and producers are relying increasingly on long-term contracts that should cover a rising share of future revenue, pointing towards smoother earnings over time. Moves like the SK Hynix sell-off therefore look driven more by sentiment, positioning, and valuation than by a sudden collapse in underlying AI demand. In U.S. tech, crowded AI trades are being rotated rather than abandoned. The Nasdaq's nearly 2% decline reflects investors trimming semiconductors and memory while adding to mega-cap platforms with stronger cash generation. Apple has pushed to new highs on buybacks and optimism around an AI-driven device upgrade cycle, while Meta and Microsoft are leaning into massive AI infrastructure builds, including multi-gigawatt data center projects. Nvidia has softened but is still discussed as reasonably valued given expectations for very rapid revenue growth and high margins, even as legal overhangs like Apple's lawsuit against OpenAI and funding pressure on peripheral AI stories show that capital is concentrating on a smaller group of perceived long-term winners. Financials and energy-sensitive cyclicals sit directly in the path of today's shocks. In U.S. banks, the upcoming results from J.P. Morgan, Citigroup, Wells Fargo, Goldman Sachs, and Bank of America are pivotal. Large U.S. banks are expected to deliver 15 to 20% earnings growth year-on-year, driven by strong fixed income and equity trading, healthier IPO calendars, and a pickup in mergers and acquisitions, with Wall Street divisions on track for record revenues. The flip side is that expectations and positioning are crowded. Competition for deposits is intense, lifting funding costs and threatening net interest margins later in the year. Flows into the investment banking leaders are said to be skewed toward long Goldman Sachs and short Morgan Stanley, which could magnify any earnings surprise in either direction, while at J.P. Morgan ongoing succession questions beyond Jamie Dimon highlight how much of the valuation is anchored in confidence in management. Energy and travel are feeling the same oil shock in different ways. European energy stocks and oil-heavy indices such as the UK's FTSE 100 have benefited from higher crude prices and wider supply disruption premia. Airlines face the other side of that trade. Record fuel costs are pressuring the group even as demand stays firm. Delta Airlines stands out, reaffirming full-year guidance, capturing a disproportionate share of industry profits, and sustaining operating margins near 9% despite higher fuel, which signals strong pricing power and operational discipline. Further out, climate and energy transition themes are shaping where long-dated capital flows. Europe's infrastructure is struggling with repeated heat waves, while governments from Kyiv to Berlin are elevating energy security and technologies, such as nuclear fusion. Multi-billion-euro public commitments and sizable venture rounds for firms like Proxima Fusion reflect a growing recognition that reliable energy has become a binding constraint on AI and data center expansion. To sum up, Equities are now trading in a zone where a live energy shock, higher for longer yields, and still strong earnings all pull against each other. Geopolitics around Hormuz and Ukraine are adding risk premia to oil and gas, while AI-driven tech, large banks, and energy remain core profit engines, but with far less room for error on expectations and valuation. The next catalysts to watch are U.S. CPI and PPI, Federal Reserve commentary, early bank earnings, and any sign that shipping flows through Hormuz are normalizing or deteriorating further. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.